The committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time, and all members will have 5 days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is entitled "The Peril of an Ignored National Debt." I offer apologies to the witnesses that we are starting an hour late due to floor votes. I now recognize myself for 5 minutes to give an opening statement. Most people know that I'm getting ready to leave Congress at the end of the year. I leave hopefully with many friends, regrettably maybe an enemy or two. A body of work I am proud of, but I also leave with some great regrets. I have no greater regret than my inability to convince more of my friends and more of my colleagues of the peril of an unaddressed national debt. Having been a veteran of the Less Than Super Committee and of the Simpson-Bowles Commission, my iPad is awash with reports saying our debt is unsustainable. In many respects, I feel I've been in this hearing 20 times before, only the numbers change, and they change for the worse. For those who will say that recent tax reform is the whole basis of our problem, I hold up the latest report that has the Treasury numbers that show that actually tax revenues are slightly up since the passage of the Tax Cut and Jobs Act. Regardless, I don't think they are a significant part of the solution nor a significant part of the problem, but it's occasionally good to actually know what the facts are. We are about to hear a dizzying array of numbers, not to mention a lot of budget speak, but I think it's occasionally perhaps good that we ponder the images of what a fiscal crisis looks like. So if I gotta have the slides, please. I tripped across a story from The Atlantic dating back 6 years ago. Photojournalists went to Greece during the midst of their financial crisis. And this is the face of a fiscal crisis. Number one, it's padlocked factories throughout all of Greece as their unemployment rate went up to 20%. One of the workers at the factory, Dimitris Manikas, actually was due to get married, and instead he was laid off and engaged ultimately in an act of violence against other workers as the factory was shut down. Slide, please. The face of a fiscal crisis is also riots in the streets. This is in front of the Greek parliament while parliamentarians were having to endorse a new austerity deal with the EU. Next slide, please. This is a makeshift memorial for a retired pharmacist named Dimitris Christoulas, who regrettably committed suicide, leaving a note that was linked to the nation's fiscal crisis. And indeed, suicides were on the increase as Greece faced their fiscal crisis. Slide, please. These are people who are rushing a train in order to get inexpensive potatoes in the northern Greek town of Thessaloniki. They couldn't afford anything else. Slide, please. Regrettably, drug addiction predated the Greek fiscal crisis, but as one government worker said, Philippus Dragamis, that now they were unable to treat the many addicts that they had in Athens. Slide, please. This is a picture of a soup kitchen in Athens' main square. Once again, I remind you, unemployment exceeded 20% at the crisis. Next slide, please. This is a picture of a gentleman by the name of Nick Boudas. When asked how he had been affected by the economic crisis, he replied, "I lost my job, I lost everything." Slide, please. This is a picture of the back of a young lady, Natasa Papa Constantino. Forgive me if my Greek pronunciations aren't correct. She lost her telecom services job and spends all day looking for work, and she was quoted in The Atlantic as saying, "I don't even listen to music now. I used to love it, but in the bad times of your life, you forget about your hobbies." Next slide. This is a picture of George Andrianakis, who has a farm, raises goats and sheep, but his profit margins were cut by 50%, and his production cost rose by 30%. He was quoted in the story saying, "I'm surviving as opposed to living." We'll forego the other slides. I think people get the picture. As I look at these pictures, again, we will see a dizzying array of numbers. We will hear much budget speak. But right before I came to office, our nation suffered the great tragedy of 9/11. And I recall in the 9/11 Commission, the very damning indictment that somehow our nation failed in having imagination. We had a failure of imagination. And I think it is important that at least this committee imagine what a fiscal crisis coming to America could be. I don't believe America will become Greece. I just don't know it for a fact, and I wonder if we could take the risk. And so to me, again, I've sat in similar hearings throughout much of my congressional career. I'm sorry that they are still necessary. But I would set what I consider to be a rather low bar of success. I would consider this hearing to be a success if every single member at least acknowledge that an unaddressed debt is an existential threat to the America that we know, and that we would collectively assume some modicum of moral responsibility to deal with this problem. I understand that the problem may manifest itself once we have all left Congress. How convenient. But one day, history will judge us. I am not indifferent as to how history judges me. I hope every other member is not indifferent as to how history judges them. I now yield 5 minutes to the ranking member for an opening statement.
Thank you very much, Mr. Chairman. I appreciate that. Mr. Chairman, since this hearing is about attention to the national debt, I think it is important for the public to understand that the Republican tax scam pushed through by congressional Republicans and Donald Trump during this Congress explodes deficits by an estimated $2.3 trillion from 2018 through 2028, leaving future generations to foot the bill. The shameless GOP tax scam contains massive giveaways for the nation's largest banks. According to Americans for Tax Fairness, the country's six largest Wall Street banks will collectively save an estimated $14 billion in 2018 alone. And it's not just banks. The tax scam includes a 20% deduction for pass-through businesses, which is a huge giveaway to hedge funds and other Wall Street firms. To make matters worse, companies are overwhelmingly using the windfall from the tax scam not to hire more workers or raise wages, but to buy back shares from their investors. This law has been very deliberately constructed by my colleagues on the other side of the aisle to benefit huge corporations on Wall Street, millionaires and billionaires at the expense of hardworking Americans. The American public and future generations will be forced to pay for these handouts to massive corporations because of the actions of the Republican-controlled Congress and this president. And of course, Republican policies such as the Bush tax cuts and the Iraq War are also major contributors to the deficit. So, when my colleagues on the other side of the aisle talk about fiscal responsibility and the perils of ignoring the national debt, it must be understood that their actions do not match their rhetoric, particularly when it comes to tax cuts for the wealthy. When we return next year in the new Congress with Democrats in the majority, this committee will reject harmful and reckless policies like these and work to ensure that our financial system is fair. We will prioritize protecting consumers and investors, making sure strong safeguards are in place to prevent another financial crisis, expanding and supporting affordable housing opportunities, encouraging responsible innovation in financial technology, promoting diversity and inclusion in the financial services sector, and ensuring that hardworking Americans and small businesses have fair access to the financial system and opportunities to thrive. So, Mr. Chairman, I thank you, and I yield back the balance of my time.
Gentlelady yields back. Today we welcome 4 witnesses to the committee. Dr. Douglas Holtz-Eakin is president of the American Action Forum. Dr. Holtz-Eakin earned his BA from Denison University and his PhD from Princeton University. Prior to joining the American Action Forum, Dr. Holtz-Eakin was the chief economist of the Council of Economic Advisors, was director of the Congressional Budget Office, and he began his career at Syracuse and Columbia Universities as an economic scholar. Mr. Brian Riedel is a senior fellow at the Manhattan Institute. Mr. Riedel received his bachelor's degree from the University of Wisconsin and master's degree from Princeton University. Prior to joining the Manhattan Institute, Mr. Riedel was chief economist for Senator Rob Portman of Ohio and worked on both the Rubio and Romney presidential campaigns. Started his career, Mr. Riedel worked on budget and spending policy at the Heritage Foundation. Dr. Jared Bernstein is a senior fellow at the Center of Budget and Policy Priorities. He received his PhD from Columbia University. Prior to joining the Center on Budget and Policy Priorities, Dr. Bernstein was the chief economist and advisor to Vice President Joe Biden. Previously, Dr. Bernstein was a director at the Economic Policy Institute and was the deputy chief economist at the Department of Labor. Last but not least, Ms. Maya McGinnis is president of the Committee for a Responsible Federal Budget. Ms. McGinnis received her BA from Northwestern University and her MPP from Harvard University. Prior to joining the Committee for a Responsible Federal Budget, Ms. McGinnis was a member of the Washington Post editorial board and has advised both candidates and members of Congress on health, economic, and tax policy. Started her career, Ms. McGinnis worked on both Wall Street and at the Brookings Institution. Without objection, the witnesses' written statements will be made part of the record. Dr. Holtz-Eakin, you are now recognized for 5 minutes to give an oral presentation of your testimony. Thank you for being here.
Thank you, Mr. Chairman, Ranking Member Waters, and members of the committee. It's a privilege to be here today. Let me take this moment to just simply thank the chairman for his service. I have sat on this side of the table many times and have learned a lot during his tenure. And let me congratulate as well Ranking Member Waters and look forward to her continued service on the committee. I don't know what to say. I have been, for 15 years, I've been talking about the budget, and I could drown you with numbers, but let me just say 3 simple things. Number 1, the outlook is dire and it will have consequences. The CBO estimates that budget deficits will average about 5% of GDP over the next 10 years. That's extraordinarily high for an economy that's at full employment. The debt in the hands of the public will go from 78% to 100% over the next 10 years and continue to spiral north on an unsustainable track. And that ultimately this will have consequences either because bond markets impose discipline, and we'll get pictures of the sort that the chairman showed us, or in an effort to stave off that discipline, the future Congresses will muddle along with disguised tax increases in the form of regulations, muddle inefficient cuts to spending, and will never really come to grips with the problem, and the economy and future generations will suffer. It's not a particularly good picture. The second thing I would say is that at the heart of this is the need for entitlement reform. Now, it's often the case that budget folks like myself talk about the need for entitlement reform, and that people envision a hard-hearted person with green eye shades who doesn't care about their welfare. I would encourage you to recognize that our entitlement programs are not good programs. The Social Security program, under current law, will impose a 25% across-the-board cut in retirement benefits to people in a little over a decade. That's a terrible pension program. We deserve a better Social Security program, and that can be done while addressing the fact that it's right now running red ink of about $40 billion a year, and that will rise. Similar stories can be told about Medicare, Medicaid, and our other entitlements. We need better programs, And in the process, we will come to grips with the fact that the CBO projects that Medicare will grow at 8% a year over the next 10 years. The Social Security will grow at 6% a year over the next 10 years. Medicaid will grow at 6% a year for the next 10 years. Affordable Care Act subsidies will grow at 5% a year over the next 10 years. There is no tax system and economy that's conceivable that will grow at those rates over the next 10 years. They are outstripping our capacity to finance them. So we need programs that are sustainable and better for their beneficiaries, and they are at the heart of the budget problem. Third thing I would say is that these changes will be very difficult. The CBO put out an interesting report recently about the size of changes necessary to stabilize the debt to GDP. If you want to stabilize the debt to GDP at historic average levels by 2050, basically 2048, you would have to impose every year deficit reduction of $640 billion. That's an enormous amount of work, and it's going to be difficult for this and any future Congress to do that. It's going to require some public education. I do not believe the American public understands the scale of the problem that faces them. They have not been told the honest truth about the outlook for the federal budget and the problems that it contains. It will require not just the things my friends on the right love, which is spending controls and faster economic growth, and it will require not just the things my guys on the left like, which is big tax increases. It will require a steady dedication to rapid economic growth, reform to the entitlement programs, which are bleeding red ink and crowding out discretionary spending, and revenue increases that make economic sense and continue the effort to broaden the tax base and not impose sharp increases in tax rates. That's a very difficult political exercise, but it is the most important thing facing this country, and I unfortunately have been saying that for the past 15 years, every year in front of members of Congress. I hope this time it makes a difference. Thank you.
Dr. Reel, Mr. Reel, you are now recognized for your testimony.
Thank you. Good morning, Chairman Hensarling, Ranking Member Waters, and members of the committee. Thank you for inviting me to participate in today's hearing. My purpose is to describe the policies that are driving a historic long-term surge in budget deficits. I will begin by asserting that few Americans fully comprehend the fiscal avalanche that has begun. The budget deficit is on pace to surpass $1 trillion as soon as next year, on its way to $2 trillion in a decade if current policies continue. And that's the rosy scenario, because if interest rates merely rise back to 1990s levels, the projected deficit is $3 trillion in 10 years, according to data from the Congressional Budget Office. The long-term picture is even worse. The CBO projects a staggering $84 trillion combined budget deficit over the next 30 years, and that assumes all tax cuts expire. It would leave a national debt at 150% of GDP, and even that assumes peace, prosperity, and low interest rates. Again, that's the rosy scenario. So what is driving this red ink? We can start with the $250 billion in annual tax cuts and the $150 billion annual cost of the higher discretionary spending caps, according to CBO. They're certainly contributing to the deficit. Yet this combined $400 billion cost is projected to remain mostly steady for the next 10 years. It does not explain why the deficit is going to jump from $800 billion to $2.1 trillion over the next 10 years under the current policy baseline. The tax cuts and discretionary spending caps do not explain the $1.3 trillion avalanche that's coming. For that coming increase, the CBO data clearly points to Social Security and Medicare. Because payroll taxes and premiums do not cover the full cost of benefits, Social Security and Medicare require a general revenue transfer each year to cover the shortfall. The cost of filling these Medicare and Social Security shortfalls, including the interest associated, will jump from $400 billion in 2018 to $1.6 trillion a decade from now. That is a $1.2 trillion increase in the cost of general revenue transfers to Social Security and Medicare and their interest. There you go. That is 90% of the $1.3 trillion increase in the deficit we're going to get over the next 10 years, according to the CBO current policy baseline. We can look at this another way with the combined 10-year figures. In total, between 2018 and 2028, Social Security will require a general revenue transfer of $2.2 trillion, and Medicare will require a general revenue transfer of $5.6 trillion. When including the $2 trillion in resulting interest costs from the portion of that spending that must be borrowed, the Social Security and Medicare systems will drain $9.8 trillion from general revenues over the next decade. The rest of the budget will run a 10-year deficit of about $3 trillion, or about 1% of GDP. The long-term figures are even more dire. The CBO 30-year baseline projects that the Social Security and Medicare systems will run a $100 trillion shortfall over the next 30 years. The rest of the budget will run a $16 trillion surplus over the next 30 years. Specifically, Social Security will run a cash deficit of $18 trillion, Medicare will run a cash deficit of $41 trillion, and the interest cost of borrowing to pay for those deficits will add $41 trillion more. So let's look again at annual growth. CBO projects that over the next 30 years, the Social Security and Medicare annual deficits and the interest cost will go from 2% of GDP to 12.6% of GDP by 2048. The rest of the budget by 2048 will enjoy a 3.1% of GDP surplus as a result of both rising revenues and falling spending across the rest of the budget. Simply put, the long-term debt problem is overwhelmingly a Social Security and Medicare issue. The rest of the budget is projected by CBO to produce growing surpluses over the long term, but it is not enough for the rest of the budget to produce surpluses large enough to balance out a $100 trillion projected shortfall within Social Security and Medicare. That's the ballgame. Thank you.
Dr. Bernstein, you're now recognized for your testimony.
Thank you, Chairman Hensarling, Ranking Member Waters, for the opportunity to testify. I suspect we'd all agree that it's not enough to label our debt as perilous. We need to diagnose its origins and prescribe ways to deal with it that introduce fiscal responsibility without damaging economic growth or hurting vulnerable Americans. Surely the first thing to do when you're deep in a hole is to stop digging. According to CBO, the tax cut passed at the end of the last year will add almost $2 trillion to the nation's debt over the next decade. That's the opposite of stopping digging. It's exchanging your shovel for an earth-moving excavator. Based on both our debt outlook and Americans' reasonable expectations about the role of government to provide social insurance and safety nets against market failures, investments in public goods, considering our aging demographics, we're clearly going to need more revenues in coming years. But my testimony will also stress that significant cost savings must be pursued in health care, an area where the U.S. spends far more as a share of our economy than do comparable advanced economies. There is no serious path to reduce the growth rate of the nation's spending that does not go through health care. However, it is essential to pursue such savings in a way that protects the living standards of low and middle-income Americans. Here are the points I hope to underscore today. We must avoid one-sided analyses. Ignoring the shortfall on the revenue side of the ledger leads to a misguided, highly partisan analysis, one unlikely to generate the political cooperation needed to sustain fiscal responsibility. This is particularly the case when considering our near and medium-term fiscal challenges, including aging demographics, climate change, inequality, and our need for investments in public goods. But it's the same thing on the spending side. I argue that reducing the growth rate of the nation's healthcare spending has to be on the deficit reduction agenda. The Affordable Care Act has made some progress in that direction, and sustainable fiscal policy demands that such efforts be strengthened, not abandoned. The 2017 tax law is responsible for this year's lower than expected federal revenues of 16.4% of GDP, a level well below the historical average, especially at low unemployment. In previous full employment economies, revenues as a share of GDP have been 18.4%, 2 percentage points above today's level, or $400 billion in missing revenues in today's dollars. Restoring essential linkages between strong economies and higher federal revenues calls for rolling back parts of the tax cut, including the estate tax reduction and the new pass-through loophole. A comparison of CBO long-term projections further underscores the revenue shortfall point. Figure 4 in my testimony shows CBO's forecast for primary outlays, spending, and revenues from two different vintages of their long-term budget outlook, one from 2010 and the most recent from 2018. Now, the logic of the, quote, spending problem case implies that projected outlays accounting for a higher share of GDP in the 2018 projection, with the projected revenue share either higher or similar to that of the earlier forecast. That is, to make it more comprehensible, the spending problem scenario should show fiscal gaps being driven more by spending, not by less revenues. In fact, the opposite is the case. Not only are primary outlays lower in the 2018 forecast than in the 2010 one by 2 percentage points of GDP on average over the forecast period, there's the figure, but revenues in the 2018 budget outlook are much lower than in 2010's by 4.5 percentage points of GDP on average. In other words, current law in 2010, not all of which was followed, to be fair, called for both higher spending and higher revenues than today's current law. And given that the revenue decline between these two forecasts has been more than twice that on average as the primary spending decline, framing the debt problem as solely or even largely a spending problem is just not defensible. Spending deals don't sign themselves. This reality, in tandem with the existence of large, persistent deficits and debt, reveal that year upon year, congressional majorities accept and add to existing spending levels. The current congressional majority has not only been unwilling to raise the revenues necessary to pay for their revealed spending preferences, they've also significantly cut revenue inflows. The essence of our fiscal problem is thus accurately tagged as neither a revenue nor a spending problem. Instead, it is this: Congress is unwilling to raise the resources necessary to pay for the institution's revealed spending preferences. Thank you.
Ms. McGinnis, you're now recognized for your testimony.
Thank you. Thank you, Chairman Hensarling, Ranking Member Waters, and members of the committee for holding the hearing today. And on a personal note, I've enjoyed working with you, Mr. Chairman, and thanks for your focus on this issue over the years. I will be brief because I agree with pretty much everything my colleagues have said, so we can move through this quickly. To reiterate, the federal debt picture is extremely bleak. The debt relative to the economy is the highest that it's been since World War II, and obviously then we had just fought a world war. Interest payments are the fastest growing part of the debt. Already, we are on track to spend more on interest than we do on Medicaid next year, and we're on track to spend more on interest next year than we do on children, meaning we will be doing more to finance our spending from the past than investing in the future. 4 years from now, we are going to be spending more on interest than on defense, and that should be cause for everybody to worry. It's a real wake-up call. Our spending is unsustainable. The vast majority of it is on automatic pilot, as are tax expenditures, another portion of the budget that doesn't get enough scrutiny. Finally, we have a debt situation that's deteriorating at such a fast pace during a time when we have strong economic growth, and this is nearly unprecedented. So as Doug Holtaken said moments ago, fixing this problem is going to be really difficult. Merely stabilizing the debt at the level it's at today, which is too high, it's twice the average that it is relative to the economy, merely doing that would take savings of $4.8 trillion. Balancing the budget would take savings of $7 trillion. To put that in perspective, almost in no years does Congress pass net savings. Almost in all years, Congress actually adds to the debt. The biggest deficit reduction plan that we've had in the past decade, the Budget Control Act of 2011, was designed to save $2.1 trillion. Most of that also we have repealed or ignored. So there's that. If we don't change course, we are likely to see slower economic growth. We will be much less prepared for emergencies or the next recession. Interest payments will continue to squeeze out other important parts of the budget, and there'll be less budgetary flexibility for the important new priorities that we are going to face in this quickly changing world and quickly changing economy. We also face new risks, so we're dependent on borrowing from abroad, and that comes with its own risks, especially when we're borrowing so much from countries where our interests are not precisely aligned. And already we've seen them pulling back on their lending to the U.S. in recent years. And because we borrow so much structurally, this does leave us very dependent. So in thinking about solutions, I think about the underlying causes. Certainly the primary drivers of the long-term debt are the growing mandatory spending looking forward. Over the next 10 years, 82% of the growth in spending will come from Social Security, healthcare programs, and interest payments. Mandatory spending has already grown significantly as a share of the budget. And these programs undoubtedly, unquestionably need to be reformed. That is not the same as saying how they should be reformed. I just think there should be so much more of a focus on, of course we have to fix Social Security and Medicare. Now let's argue about how we can do that. There are many options on the spending and revenue side, but every year that we delay making those fixes jeopardizes people who depend on the programs. Second, we need to stop making the problem worse. The minimum thing that we should be able to agree to is that we are not going to add more to the debt. Recently, we have had a tax bill that added $2.7 trillion to the debt after growth if you make it permanent and you account for interest payments. Likewise, we've had an increase in spending that got not nearly as much attention, but if you make that permanent and account for interest, that's another $2.4 trillion. So we have done a lot of digging in this past Congress. Third, we need to pay for what we spend as a nation. If we're not going to get our spending under control, and there really has been very little appetite for that in the past Congress, we've increased spending, not decreased it, then we are going to need to increase revenues. And I point out that if what you want is a smaller government, the way that you do it is not actually to cut revenues, it's to cut spending. So that's where the focus needs to be if that's your vision of government. So I want to conclude by taking a step back, because the debt is a huge threat to our economy, but I also think it's come to represent so many of the things that are broken about how we're governing these days. This is a really difficult issue. These solutions, none of them are the ones that people like to talk about. They're really hard choices. And we've kind of lost the notion that budgeting is about trade-offs, limited resources, and hard choices. To fix the situation, it is going to have to be bipartisan. And we know that it is a difficult environment for bipartisan cooperation. That's going to be required. It is going to require that we focus on policy more than politics, and we know that right now in our governance system, we're pretty consumed with politics over the issues. We tend to legislate, we always legislate at the last possible minute. This is about getting ahead of a huge problem that we know exists. Oftentimes, there are political motivations to keep the problems out there, to keep them festering. This is something that you can demagogue against on either side. We have to, for the good of the economy and the next generation, get ahead of the problem. And there will always be differences and preferences about the size of government. So it shouldn't just be that because we can't agree on things, we punt on it. It should be that that's what the legislative process helps us figure out. Finally, I would just say there are real external challenges. We have external policy threats to our democracy. We have economic and competitive threats from China. We have new kinds of security threats that are completely new. And we're going to have different kinds of work patterns in the economy from technology. And so we need a really strong starting point, and that starting point is our budget. Thank you, Mr. Chairman.
Thank all the witnesses for their testimony. Chair now yields himself 5 minutes for questions. Is there anyone on the panel who believes that we can avoid a debt crisis without altering our debt course? Raise your hand. So we at least have agreement that this is a very, very serious matter. Let me briefly deal with taxes, because I really think that taxes are a sideshow. I think discretionary spending is a sideshow. I think the main event is what do we do about health care and retirement spending? How do we get reasonable, if not better, health care and retirement security at a cost that does not bankrupt future generations? But just for the record, I will state it again, for those who weren't here, fiscal year over fiscal year, revenues are actually up. Don't take my word for it. Look at CBO numbers, look at Treasury numbers. And isn't it true, Ms. McGinnis, that if the Tax Cut and Jobs Act creates 2.3% economic growth, that the tax relief pays for itself?
If you do not count the cost of the extenders, then increase of GDP growth per year of 0.4, it would pay for itself.
I would point out that currently we have GDP growth of 3%, which is commensurate with the post-war average. But again,
But I just want to qualify that that would be for every year over the decade.
no, I understand
And
that.
nobody's
I
proposing that yet.
understand that. So whether you believe tax revenues are part of the problem or part of the solution, it is a small part of the problem or it is a small part of the solution. I was struck that almost every witness said something similar. I'm paraphrasing. I didn't get the words exactly, but Mr. Riedel, I think you said that our long-term debt is overwhelmingly Social Security and Medicare, and I believe you specifically said 90% of the increase in our debt is attributable to Medicare and Social Security. Is that correct?
90% of the increase in the budget deficit over the next 10 years will be Social Security and Medicare.
And Ms. McGinnis, I think you said in your testimony that the largest drivers of our long-term debt problem are healthcare spending and Social Security. Mr. Bernstein, I think you said no serious path to reduce the rate of growth of our nation's spending that does not go through healthcare. And Dr. Holtz-Eakin, I think you said that our budget deficiencies long-term are pension and healthcare spending. Did I more or less get everybody's language right? Does anybody wish to disagree with my characterization? So again, this is what our challenge is. I was struck by something I read in your testimony, Mr. Riedel, but I don't think you treated it in your oral presentation. But if we treated this only on the size of the tax, if we only treated this on the revenue side, can we just tax the rich and take care of our national debt? What size tax increase would be necessary, and would that eventually hit working families?
That's a very good question. Right now, one way of looking at it is if we were to take every dollar earned over the $1 million threshold, and let's assume everyone keeps working, every dollar they earn would raise 5% of GDP, which is not enough to even balance the budget, much less pay for anything new over the long-term period. Additionally, if we doubled the 35% and 37% tax brackets to 70% and 74%, that would raise 1.6% of GDP before you take into account any economic effects. So when you're looking at deficits growing to 5, 10, 12%, mathematically you can't get there from here on just raising taxes on the rich.
Can we grow our way out of this debt crisis? I've seen figures that tell me that we would have to have something approaching double-digit economic growth for almost a generation. So can we grow our way out of this? Dr. Holtz-Eakin?
No, there's no plausible GDP growth rate that would solve this problem.
So Ms. McGinnis, where does that leave us?
That we can't grow our way out of this problem.
You agree as well. Yep. So that leaves us back to health care and retirement security. So for those of us who've been toiling in these vineyards, regrettably, unsuccessfully for a number of years, there has been the search for the elusive grand bargain. I remember vividly when I was on what I affectionately call the less than super committee, walking in as co-chairman and offering my friends on the other side of the aisle the following deal, and that was, we want then Chairman Paul Ryan's premium support for Medicare. What size tax increase do you need to give it to us? I was told that was off the table, but that indeed significant entitlement reforms would be presented. That did not occur. So again, if there is a grand bargain, I agree that this will take a bipartisan lift. It will be a heavy lift. It will take leadership. And yes, I am leaving Congress, but I would say once again that if one side would bring to the table premium support, age indexing, and Social Security carve-out accounts, I would certainly lend my voice. And if I was still in Congress, I would lend my vote to a tax increase, as bad as that policy is, to save us from national bankruptcy in the vivid images we regrettably saw from Greece. I'm well over my time. I now yield to the ranking member for her questions.
Dr. Bernstein, according to research prepared by the Tax Policy Center, 87 million households with incomes under $200,000 a year will see their tax burdens increase by 2027 as a result of the new tax law. Can you explain how this increased burden will affect wealth creation for middle-class families?
Yeah, I'm glad you asked me about that, because I think one of the things that's been left out of the discussion so far, particularly with this emphasis on Social Security and Medicare, is what those programs actually do for lower and middle income families. So here's a number we haven't heard yet today. The average Social Security benefit to a retired worker is $17,000 a year. Now, I find it hard to believe that members of this committee believe that that's lush pickings that need to be cut in order to sustain a fiscal path that's much more promising than the one we're on. Medicare benefits are far less comprehensive than those offered by a typical employer plan. Traditional Medicare doesn't cover hearing, dental, and vision care. And so the idea of a middle-class tax increase while quote, reforming, which I believe members are, who are raising this really mean cutting these programs that families depend on, would very much redound to the detriment of the living standards of millions of families in this country.
Dr. Bernstein, you stated in your testimony that significant cost savings must be pursued in health care, but it must be done in such a way to protect the living standards of low and middle income Americans. Can you describe how you think these costs should be reduced and what effect it will have on the debt over time?
Yeah, and I appreciate the question, because I am not at all disagreeing with the concerns of the chairman or my fellow panelists on the sustainability of the path. I'm saying that the notion of cutting benefits that middle and lower income families depend on is, I think, unacceptable. So I think we have to look for reforms in the delivery system. These get to be in the weeds pretty quickly. We're talking about accountable care organizations, bundling payments, medical homes, value-based purchasing initiatives. We're talking about initiatives to reduce the cost of prescription drugs that are far above those of that and other advanced economies. And one issue that I think is particularly exciting, given the change in political dynamics here, is moving more people into Medicaid and Medicare. If you look at cost growth per capita, health spending has been growing significantly more slowly in the public sector than the private sector. So both the ACA, the Obamacare Medicaid expansion, and greater Medicare eligibility have the potential to provide a lot more Americans with access to affordable care, and this will reduce the nation's health care bill. Now, I'm not endorsing Medicare for all or Medicare for more or any specific plan, but I am saying that shifting people to more expensive, less efficient private care into public care is actually one way to reduce that pressure point in the budget.
Thank you very much. I'd like to share with you a few thoughts about the vision that some have about how we can deal with this debt problem. First of all, do you understand or can you explain how providing early care and education for children from birth to kindergarten could be considered in this whole discussion?
I think that's also really important. We're the only advanced economy that doesn't provide some form of universal care for children in their early years. And economists of all stripes, and I suspect other panelists here would agree with me, find this to be leaving serious investment on the table that pays back at a rate of 6, 7, 8 to 1 over the lives of these kids. That is, you get this money back later in their lives because of the advantages they get through quality such quality investments. Now, this is part of the non-defense discretionary part of the budget typically. We haven't talked much about that. I respectfully disagree with the chairman's dismissal of that as not not an important source of what we're talking about here, because spending in the NDD side of the budget, where these kinds of investment will come to, is at an historical low, at great cost to the types of services that represent investments in our future.
Thank you very much. I yield back.
Gentlelady yields back. Chair now recognizes the gentleman from Kentucky, Mr. Barr, Chairman of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. Thank you very much for holding this very important hearing. I don't think there's anything that we're doing in Congress that's more important than averting a debt crisis and saving the American people from national bankruptcy. It is alarming to hear your testimony today. I've got a few questions. We hear a lot about the Tax Cuts and Jobs Act as a driver of the deficit. Dr. Holtz-Eakin, are revenues up since the passage and enactment of the Tax Cuts and Jobs Act?
Revenues are up. That's the data that the chairman cited. It's also true that the CBO in its analysis pointed out that revenues would go back to the previous baseline within the 10-year window. So there's no out-year implications from the Tax Cuts and Jobs Act on the revenue side.
So, the federal government is actually taking in more revenues today than the federal government was before enactment of the tax cuts. Is that correct?
Yes.
Let me ask you and also Ms. McGinnis a question about the possible solutions here. We heard Dr. Bernstein talk about cutting benefits. Could the Congress actually increase benefits in Social Security and Medicare while at the same time reducing the deficit or even reducing the debt if Congress gradually raised the retirement age for younger workers in both Social Security and Medicare?
I don't think retirement ages alone are going to come near to solving this problem. They might make sense. We have parts of the population that are living longer, and you might want to index to that. Other countries do. But that's not a solution in and of itself. It's the core structure of the programs that's going to have to be addressed.
Well, Ms. McGinnis, how much of a solution is that for younger workers who have longer life expectancies? How much of a contributing solution is that?
So it depends, of course, how quickly you raise, when you would start, how quickly you would raise it, and how high you'd raise it. You could index it to longevity, for instance. It's a decent fraction. It's maybe 30, 40% tops, depending on how aggressive you are. But I think it's unquestionably something we should consider. Obviously, life expectancies are much longer. When Social Security started, life expectancy was 62. We should have known the first recipient lived to be 100. It was kind of a sign that actuaries aren't always right. It makes sense, and you build in protections for people who aren't able to work longer. So of all the different policies, in my mind, it's one of the most sensible. It's not going to fix the problem, but it's one of the most sensible we should be considering, particularly for Social Security.
Well, would it be feasible to, and maybe it would curtail some of the contribution that it would make, would it be feasible to actually enhance the benefit structure for near retirees or current retirees, particularly low-income retirees, while at the same time adjusting retirement ages for younger workers who do have larger life expectancies as a political solution to this crisis?
Yeah. I believe it would be. I mean, I think you want to make a solution as comprehensive as possible, and that means there's a lot of levers you can move. We actually have a Social Security simulator you can play with online to come up with this. But I think that certainly a part of a comprehensive plan should include bump ups for people near poverty, so you have a bare minimum benefit. Also, where poverty is highest is for the very old, so you can do an old age bump up. But the truth is that many people who are retired are one of the more well-off cohorts. So there's a lot that you can afford from people who don't depend on the program that can also contribute to this. But in terms of political benefits, starting something today, like raising the retirement age that starts down the road, kicks in the future, is obviously desirable from political.
Well, this gets at the point that Dr. Holtz-Eakin was making earlier, that our retirement programs aren't really necessarily good programs, and that if you actually enhance the safety net for those maybe at the lower income spectrum, but gradually raise the retirement age, you'd actually have a safety net that would work better for many retirees. So it seems to me that might be the way we ought to be thinking about modernizing our safety net and our retirement programs. Dr. Holtz-Eakin, you might want to comment on that?
I want to just echo everything that Maya just said. There have been about a half dozen bipartisan commissions that have looked at Social Security in particular, and all of them come out with recommendations that include increasing the minimum benefit, increasing benefits for the very aged. Those are the places where the safety net's very weak, but not giving everyone a benefit increase. High lifetime earners really don't need one, and in fact could probably have slower growth in their benefits. And so there are ways to do this that would make Social Security sustainable over the long term and a better program.
Thank you. My time has expired.
Chair now recognizes the gentleman from California, Mr. Sherman.
Mr. Chairman, I want to thank you for those initial slides where you show us Greece and an economic catastrophe, but you didn't have to go to Greece. Just go to the Midwest and our small towns, unemployment, lower paid jobs replacing higher paid jobs, opioids, suicide, and for one of the few times in our history, and a decline in life expectancy. We will be able to build the largest and highest house of cards in history before it collapses, because the whole world loves lending us money and has made our currency the reserve currency. When S&P cut our credit rating, our cost of borrowing went down. We, unlike every other institution and entity in the world, are being given the unlimited credit line until it collapses. We've got to look at spending and taxes, but there are a couple other issues. And as for the crises we face, it's the risk of a financial meltdown, and there's more to be done with Dodd-Frank. There is the enormous trade deficit, the largest in the history of the world, ignored by Presidents Bush and Obama, and now with Donald Trump at least focusing some attention on it, not necessarily having any success or doing it the right way. So outside of looking at revenue expenditures, which everybody else is going to look at, we need a foreign policy that not only recognizes our ideologies and our objectives, but also the limits to our means. And when we talk about burden sharing, it's not enough to get our European allies and others to spend more. It should be in a way that we can spend less. Otherwise, there's no advantage to it for the American taxpayer. One thing that happens in this room is we bring the Federal Reserve Board here. They generated up to $100 billion in profit in 1 year from quantitative easing. We, in many cases, not me, disparage them for that. We need to encourage the Fed to generate a profit. Every business person I talk to in my district says, why can't you run the federal government more like a business? And I say, well, we've got this $100 billion profit center, and we give them instructions to say, ignore profits and be embarrassed by them and try not to do it again. That is an absurd way. We should be legislating so that the Fed has as a secondary objective to stable prices and low unemployment, the generation of a profit. In addition, every 0.1% of increased interest rates raises our debt by $15 billion. We have a strong interest in low interest rates if we want to reduce the deficit. On health care, we have lower life expectancies while we're paying more. All of our debate is on how to pay these skyrocketing costs. None of our debate is how to provide health care, how to make us healthier for less. And a critical part of that is we have to regulate by fiat pharmaceutical prices. Unregulated monopolies will have skyrocketing prices. As to spending, $17,000 is not lavish Social Security benefits, but think of how much we could lower it if we just convinced seniors that dog food was healthy. I think the idea of cutting the Social Security benefit is absurd. When it comes to discretionary spending over the last 30 years, we've averaged 7.4% of GDP. Last year, we were down to 6.3% of GDP. In looking at total spending at federal and state levels, UK, Germany, and France average 47%. We spend 37%. We have a revenue problem. In the year 2000, a very prosperous year, we collected revenue of 20% of GDP. We're projected 16.5% in 2018, and in prosperous years, we should be collecting far more. And we need to, when it comes to the IRS, we have cut their enforcement budget by 23%, even though every dollar we invest in the IRS collects $6 in direct revenue and generates another $18 in, encouraged voluntary compliance from people who are not directly audited. But instead, we glorify tax evasion and we vilify tax collection. Corporate taxes are now going to be down to 1.1% of GDP. In other prosperous years, it's roughly double. And on corporate taxes, we have this glaring loophole when it comes to international taxation so that we collect zero when a factory is moved overseas. We've got a lot to do. I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Florida, Mr. Posey.
Thank you, Mr. Chairman. Thank you for holding this meeting. It's perhaps the most important one you've held this year. And I appreciate the witnesses to be here and talking about the real peril of the debt. Unfortunately, anytime we discuss the debt, we always talk about it in bean counter terms or esoteric platitudes, and you wonder why the public doesn't understand it. It's because it's never been put in practical terms that they could cope with or grab with. If we think about $1 trillion, you know, we're $20 trillion in debt, and significantly more probably for the unfunded future liabilities. We know that it was 29,701 years ago, before Christ, that equates to $1 trillion, if we put it in seconds. So the only way I think the average person can look at this debt is if we knock 9 zeros off of it and equate the debt in our country to a family with roughly, very roughly here, $40,000 a year income, spending $25,000 a year on rent. They can't live off the difference. And so we have a family that earns $40,000 a year about with $210,000 on their MasterCard, depending upon which actuary you look at, for underfunded liabilities for Social Security, Medicare, Medicaid, interest on the debt, and veterans benefits that have already been earned, $800 to $1 million. And it looks pretty hopeless. And anybody that talks about the country being bankrupt is skewered. This is, I don't know if you can see it from here, this is a $50 trillion bill in Zimbabwe currency. My office gave it to me for Christmas. It's basically worthless, except it has Ron Paul's signature on it. That makes it priceless to me. But in 1980, a Zimbabwe dollar was worth the same as one of our dollars. And anybody in Zimbabwe that maybe had $5 million in the bank thought they were pretty secure. But at the time they gave me this currency, it cost $10 million in Zimbabwe currency to buy a loaf of bread. And so I think, and I've asked a number of economists, would you write a paper on how this affects the everyday American, the hyperinflation that we're invariably going to suffer if we continue to accumulate the debt that we are, like they have done in Zimbabwe and many other countries that I'm sure you're familiar with. We don't have time to discuss all of them. And they all just say, well, you know, hyperinflation is really bad, but they don't go into the real pain of it. And the video the chairman showed beforehand shows a picture of it. It leads eventually to hunger and violence, as we're seeing some in South America now. And so I would hope that somebody could, with the knowledge and ability, could articulate this in a way that the average American can understand. the average American family, if they had $2 million in the bank now, they'd think they'd be good to go. Their retirement would be secure. But if we have the hyperinflation that's invariably coming, if it gets as bad in Zimbabwe, their $2 million in the bank wouldn't buy 20% of a loaf of bread. And that, that's not something that is beyond the realm of possibility. And I oftentimes see adversaries think we actually need to spend more money, and we know the only people that come through these challenges well are the uber wealthy. The middle class and the poor get crushed every time this happens. The uber wealthy make out because there become some bargains in the marketplace that they're able to take advantage of. And so, there are clearly people in this country in high positions that would actually like to see this happen, would like to see Americans suffer this because they would gain personally like they have in other countries where they've destroyed economies. And it also helps their social agenda. So I would like to ask each of you what you think is the most dire prediction of the hyperinflation or the continuing to spend without increasing productivity that we have now.
I think you've said it exactly right, which is the consequences will be that when the crisis hits, there will be reactions in policy at the federal level, higher taxes, slashes in spending that will exacerbate the economic downfall. That will be concentrated largely on the least well-off in the United States. And so when you think about, how awful it is, say, to do Social Security reform, compared to what? Well, compared to that, those people will be much better off.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you, Mr. Chairman, and I thank the ranking member for calling this meeting and all of our panelists. I'd first like to ask Dr. Bernstein, you mentioned in your written testimony, not your spoken, but your written testimony, that one of our main challenges in the near and long term is climate change. And I'd like you to expand on that, and how is climate change going to impact our budget?
We're already seeing it impact our budget. The Congress consistently has to make emergency spending appropriations to offset storms that have become more intense over time. And I think it's widely agreed upon, climate scientists, which I admittedly am not, that the intensity of these storms, droughts, and fires, to the latter being an extremely timely reference on the West Coast in particular, are related to climate change. And it's a key point that I wanted to underscore, because there is no private sector firm or function that's going to allocate revenues to offset these disasters. This has to be viewed as a public good that Congress will increasingly need to allocate resources for.
Thank you. And in your testimony, you said that reducing the pace of healthcare inflation is the key to controlling the deficit. And you showed how the Affordable Care Act actually has reduced the pace of healthcare spending while also expanding needed coverage to people. So it's fair to say that if the Texas judge's decision last week is upheld and the entire Affordable Care Act was struck down, this would likely make the deficit problems even worse, correct? And can you expand?
Yeah, that's correct. And in fact, figure 1 in my testimony shows how healthcare costs have actually declined as a share of GDP, both in terms of actual costs and projections from 2010 to now. That's not all the Affordable Care Act, but certainly it's part of it. And my testimony goes through a number of interventions in that space, including reducing the cost of prescription drugs, which I think has real currency among both Congress and lots of families right now. And I talk about other ways in which the delivery system can be made more efficient. I think one exciting aspect of the new House majority is an interest in shifting people to from more expensive private care into public care where costs are growing more slowly.
And you noted that with interest rates rising, the interest cost that the federal government pays is projected to nearly double over the next decade, from 1.6% of GDP to about 3%. And of course, interest rates were held at historically low records after the financial downturn for roughly around 8 years. So my question is, did Treasury do enough to lock in low interest rates for taxpayers over the past decade? Could they have reduced future interest payments for the government by issuing more long-term 30-year bonds at very low interest rates?
That's an interesting question. You know, I think there has been a little bit of that in terms of the shifting of the maturity of the stock of our debt. I know the Treasury doesn't try to implement those kinds of timing interventions and typically kind of keeps the maturity at around a 5-year level. You know, I take your point, and certainly it's been a historical trend, low interest rates across the board, not just here, but in other economies as well. So I think that is worth considering and looking at.
Okay, well, thank you very much.
My pleasure.
And I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Arkansas, Mr. Hill.
Thank the chairman, thank the ranking member for this important hearing. It's a hearing I wish we had every Congress, several times during each Congress, so that we can keep this critical issue. It's an existential threat to our country, our national defense, our economic well-being, our household well-being. And yet in the 4 years I've served in Congress, two Congresses, this is the first hearing that I've participated in where the national debt was a topic. So thank you for doing it. Dr. Bernstein, you talked about the need for slowing healthcare expenses as a major contributor to out-year deficits. I think we all agree with that. And you argue that the federal programs are more cost-effective than private insurance or private coverage. And so you seem to be arguing that more government is what we need. You say you want more government. You're excited about the new Democratic majority because they're going to be for Medicare opt-in and Medicare for all, and yet you repudiate supporting Medicare for all, too, in your answer to a question. You said you didn't support it. So are you for more government, and that's how we're going to lower prices in the health sector? Is that?
Yeah, well, first of all, I want to be clear. I don't think I ever used the word cost-effective. What I said was that and this is just an empirical fact, the price increase of the public programs is considerably below that of the private sector. Part of that is the public programs are not running a profitable kind of enterprise. It's a different sort of thing. My point is not to come here and say, Congress, get to work on Medicare for all. I don't know what the right policy is in that regard. My point is simply almost an arithmetic one. When you move people from the more expensive sector to the less expensive center, by which I mean wherein costs are growing less quickly, that the country will spend less on health care. And yes, you're right to suggest that that does mean more people under government coverage.
And yet Medicare is growing at something like 6% a year, right, in outlays? Is that approximately how it's growing?
Yeah, approximately. I think that's about right.
So 3 times inflation.
Well, okay, but what's the private sector growing at? It's more like 12 or 14. So that's the difference that I'm tapping there.
Anybody else want to comment on that? Dr. Holtz-Eakin?
I
Go ahead, Dr. Real.
If you're making the comparison between private and government, I think we see this a lot in the Medicare for All debate. If you're going to move more people into government coverage, whether or not it's more cost-effective in terms of national health expenditures, you still have to raise the taxes in order to finance it. You still have to move the resources from the private sector to the government. And we see this a lot in the Medicare for All debate, when people say, well, if we nationalize health care, national health expenditures might fall. Even if that's true, if you're going to move $32 trillion from the private sector to government, you actually have to come up with a $32 trillion tax to move along with it. And at this point, nobody's come up with a tax that would actually move it all. And so I think when we're talking about moving more people onto government health care, even if it's cheaper for the individual, you still got to come up with a tax, and that's going to have effects.
Yeah, I just wanted to be on record that someone's paying for that differential, and it's the American people, no matter how it's disguised. We voted on a balanced budget amendment last year in the Congress, and that's something that over the years, you know, I reluctantly support that now. I called on Kevin McCarthy to bring it to the floor for a vote. It was very narrowly passed in the 1990s during a period when both Democrats and Republicans seemed concerned about the budget deficit. And so it failed, but I think it's an important part of the household awareness factor. I support it for two reasons. One, I think it could be crafted to produce a long-term benefit to the country, but secondly, it gets this on people's radar screen in a way that's succinct. How the four of you feel about a balanced budget amendment?
I feel terrible about it.
Yeah, well, that doesn't surprise me. Doug?
I've reluctantly come to the conclusion that it's a good idea. You know, I'm a PhD economist. I've had my common sense trained out of me, but it's an example of a fiscal rule, something that binds the Congress in a way that they can't bind themselves and have never been able to bind itself. And done correctly, you could have a transition to get to balance that's not too abrupt, and you could have exceptions for wars and emergencies.
Yep.
So I also reluctantly have moved in that direction. A couple caveats. I don't think balancing the budget on an annual basis is important at all. I think it's important over a business cycle, so you want to think about that. I don't think it should be a replacement for offering the policy, so I get a little uncomfortable when people talk about a balanced budget amendment but don't talk about balanced budgets themselves. Like, you know, you need to do that. And another thing I would direct people to look at is the Joint Select Committee gave a lot of thought to debt targets, putting debt targets on a glide path. I think that, without amending the Constitution, could be a solution as well.
Thank you. I yield back, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman. I was anticipating that we would hear from Mr. Lynch, and I will gladly yield to him now since he outranks me, if that is proper. I thank you for the opportunity. For edification purposes, when we talk about retirement security, I think it might be appropriate to let people know we're talking about Social Security. Is that a fair statement? Anybody differ?
It depends exactly how you're talking about retirement security.
Well, let's just talk about how we are talking about it today. Today, I've not heard anything other than Social Security mentioned as we relate to retirement security.
Social Security is the largest component of retirement income for middle and low-income people. That's indisputable.
And today, we've been talking about Social Security. Is that a fair statement? Anybody differ? It's important for the people at home to know that we're talking about their Social Security when we say retirement security today. There are other forms of retirement security, obviously. Now, when we talk about Medicare, we're talking about a program that covers pre-existing conditions. Is that a fair statement?
Yes.
As a matter of fact, we have Medicare because, quite frankly, insurance companies don't want to cover pre-existing conditions. Anybody differ? They don't want to cover pre-existing conditions. If they covered pre-existing conditions, well, permit me to ask this, because I'm looking at faces of people at home can't see what I see. Why do we have Medicare? Tell me, why do we have it?
Because it becomes harder to get insured as you're older and more sick.
And why is it harder to get insured when you get older?
Because it's more expensive.
Why is it more expensive?
Because you're sicker.
Yes.
Yes.
Conditions. Insurance companies don't want to insure sick people. They want to make profits. Medicare, on the other hand, takes anyone who is at the appropriate age, and they get coverage. There are people in this country who don't get coverage at one time before Obamacare, as they call it, until they could get Medicare. Is that a fair statement, that there were actually people who could not get health care until they were at the age of receiving, well, they could get emergency room care. But
I
the
think
kind
it's
of
got to be,
the kind of health care that insurance would ordinarily provide, they couldn't get.
I was just to say that it's got to be the case that the uninsured rate among the 65-plus population is, close to zero, and that's a function of Medicare.
Yes. So we can have the insurance companies in control, and they are. We can go back to not covering pre-existing conditions under the guise of some sort of program that has less cost and better coverage. Language is a wonderful thing, but it really doesn't take care of a sick person. Saying we're going to have better health care for you really doesn't take care of a sick person. The reason Medicare exists is because insurance companies don't want to cover sick people, and older people are sicker than younger people. Now, all of this is important, dear friends, because in the debate that we have here, you clearly have one side that took a good amount of time to develop a health care program that covered pre-existing conditions. You have another side that went out of its way to say, we are going to repeal and replace. They had the House, the Senate, the presidency, and to this day, they have not repealed and replaced. And they cannot repeal and replace because their paradigm, the model that they use, is a model that benefits the insurance companies as well. So at some point, we have to ask ourselves, are insurance companies more important than sick people? This is why people talk about Medicare for all, because you can cut out those who rake the profits off the top at the expense of health care. Thank you, Mr. Chairman.
Time of the gentleman has expired. Chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman. I would note that the insurance companies, frankly, have done quite well over the last few years. And with the regime that is in place right now, while everybody's premiums have skyrocketed and made it very difficult for people to afford health insurance, I want to talk a little bit about where we're at. And Mr. Holtz-Eakin, except for Social Security and Medicare, public revenues are more than enough to pay for public outlays. Unfortunately, however, this surplus of revenues from almost all of our public programs falls far short of bridging the budget gap from mandatory spending. What would happen to our economy if we sharply increased taxes to fill the yawning budget gap?
There would be detrimental impacts on the long-term trend growth in the economy, and it would harm growth in the standard of living, and there is no sensible way to tax our way out of this problem without great damage.
Would people have less incentive to work?
Yes.
Talk a little bit about the impact of what the interest payments are going to do to our budget. Mr. Vidal, interest payments on our national debt are rising to levels that crowd out spending for national defense, also crowds out spending for domestic infrastructure and other critical government activities. John Bolton, our U.S. National Security Advisor, thus recently characterized our national debt as an economic threat with national security consequences. Talk a little bit about the impact of that growing interest obligation that we're going to have.
First off, the interest costs are skyrocketing, as you know, and the CBO assumes low interest rates. The CBO assumes that 30 years from now that we're going to be paying 4% interest on a debt that's huge. So it's going to skyrocket. If the interest cost goes up, you have higher costs of taxpayers, you have slower economic growth, you have less investment, slower economy.
According to the CBO baseline, the total deficit for the period 2019 to 2028 is expected to be $12.4 trillion. That $12.4 trillion gap isn't a result of the Tax Cuts and Jobs Act, is it, Mr. Riddell?
The overwhelming result, it's overwhelmingly the result of transfers to Social Security and Medicare that will total nearly $10 trillion over that period.
I want to talk a little bit about revenues, because I frankly think there needs to be more revenues. But the question is, how do we get more revenues? And the idea is to have a healthier growing economy so that more people are getting back to work and getting people back in the game again. Look at our labor force participation rate and doing what we can to get more people in the game. But there's another issue that's out there that really doesn't get enough attention. Back in 1995, I was working at a law school taking a look at law school applications. And we were getting information from the American Bar Association telling us that there has been 800,000 fewer 22-year-olds in 1995, a precipitous drop in the number of 22-year-olds. And you can do the math and figure out what 1995 minus 22 was. It was 1973. And a decision that happened in 1973 that people started having fewer children. Fewer children were born. And then you look at the data over the years. 1 million, 1 million, 1 million. Fewer people that were coming into this world. People that could have lived lives of productivity, people that would have been able to fulfill God-given dreams, taken their talents and skills, and joined the labor force. In 1995, there were 800,000 fewer of those people, and year after year after year, fewer people coming in. I noticed today, or yesterday, Wall Street Journal had a piece, U.S. population grew at the slowest pace in more than 80 years. Inevitably, we have to be looking at people coming into the country, immigration, people who want to come here, pursue their God-given dreams, the talents that they've been blessed with. But really, isn't it at some level a people issue? And if we want more revenue, there needs to be more people out there pursuing their dreams. I wonder if anybody want to kind of reflect on that a little bit as we look to grow this country. Mr. Holtz-Eakin.
I'd say two things. I think one of the really remarkable pieces of the past year and a half of economic growth has been the number of people who have been drawn into the labor force and into work. I did not think the U.S. economy could continually create about 200,000 jobs a year over the past 12 months. The sort of typical demography would have dictated about half that. So that's been a huge success, and that's your point. Over the long term, though, you need not just more people, but more productivity and revenue per person, and that's the major challenge.
Yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Connecticut, Mr. Himes.
Thank you, Mr. Chairman. Before I begin, I'll yield 15 seconds to Mr. Green.
Thank you very much, Mr. Himes. Let me just respond to something that was said about the cost. The other side, my good friends, have done everything that they can to sabotage the Affordable Care Act, kill the individual mandate, and refuse to accept the expansion of Medicaid. In Texas, we had $100 billion accorded, and the state of Texas, by and through its agent, the governor, refused to accept that money. So there are good reasons for what's going on, and they are associated with efforts to sabotage the Affordable Care Act. I thank you for the time.
Thank you, Mr. Green. Good afternoon, everybody. Thank you for being here. I'm an inveterate optimist. Always have been. It's a fault. But on this issue, I've just given up. I'm a pessimist. I've given up in an annoyed way. I hate sitting in rooms like this, hearing everybody mouth pieties about how important this issue is while doing everything they can to make it worse. I've seen that now for 10 years. And I'm not even going to get into partisan finger-pointing. Nobody's interested in actually addressing this problem. I joke that I've probably gained 10 pounds over these 10 years with the many dinners that Ms. McGinnis has held to try to bring people from both parties together to think about this. And by the way, it's not just us, it's the outside world. Admiral Mullen, for whom I have infinite respect, said 9 years ago that this is the national security crisis of that time. My Republican friends have been saying forever, interest rates are going to skyrocket. Well, no, none of that happened. And so this is the ultimate in the boy crying wolf. So surprise, surprise, nobody out there is taking it seriously, probably because none of us have ever, and quite frankly, the outside, you guys, have probably not contributed to the sense of urgency or to how we can solve this. So I actually do have a question. I'm a pessimist on this. I've given up. None of us are going to go to our constituents voluntarily and say, hey, we can cut spending or raise taxes, and yeah, growth would help, but it's just not going to happen. So my question is, I believe that it's going to be forced upon the Congress. Eventually, what is not sustainable will in fact prove not to be sustainable. So my question, and it's actually a serious question, I'm not trying to make a point here. My question is, what is the timing and characteristics of that forcing function? Again, I heard 10 years ago that we were at the moment of truth from my good friends Simpson and Bowles. What is the timing and the characteristics of that which forces the Congress to finally deal with this problem in a meaningful way?
So probably one of the most frustrating things, and you know from your background in finance also, is that we cannot time the markets. We wish we knew that there was one limit when the debt as a share of the economy suddenly was going to switch. So much of this is about other options, how other countries are doing. To quote many people, oftentimes we are seen as the best looking horse in the glue factory. People still lend to us even though we're in bad shape because we're in better shape than others. That is not what we want it to be, but it depends. The point is that when markets change and they stop lending to us, and it is worrisome that both China and Japan have pulled back on their lending to the U.S. over the past 2 years. But when that changes, it's too hard to get ahead of the problem. And because you are one of the people who's most focused on this issue, you all can't give up. You're our political leaders. We need you to lead on this because we know that if we delay this, it is going to leave this country in a really weakened condition.
So I get the capital markets are hard to predict, and I'm interested in listening. I would also be interested in hearing about when that happens. Does it happen slowly or quickly? Is it a massive market dislocation with a 200 basis point rise in treasuries, or does it happen slowly over time?
Go ahead.
It happens quickly. It happens quickly in emerging markets. I suspect it would happen a lot less quickly here. I do have one fact about timing that you may find interesting and useful. It does historically appear to be the case that when countries enter recessions and their debt to GDP ratio is around 80%, which is exactly around where ours is, they're less likely to do enough to offset that downturn. So one argument I have for the urgency of reducing the debt to GDP ratio is that there's a recession out there somewhere, perhaps in the next few years, nobody knows. And if we stay on the trajectory we're on, we're likely to do less to offset it, which would mean more real-time pain for American families and households.
I just want to add that when we say, well, we were told it was the moment of truth 10 years ago when the sky didn't fall, it did fall if we believed in shielding those under 55. Remember a long time ago we said no changes to anybody over the age of 55? That was the moment of truth. Now we're to the point, a third of the baby boomers have already retired, and another third are going to retire in the next 6 years. So the moment of truth in terms of shielding and phasing stuff in has passed.
Thank you. If the chairman will indulge me just 5 more seconds. I think what we need, I was talking to Ms. McGinnis about this. I don't believe we're going to act. It just, the structure does not permit it. So I think what we need you to do is to tell us what it looks like and what we can do quickly to fix the problem once we are forced to do so. Thank you. I yield back, Mr. Chairman.
Gentleman yields back. Chair now recognizes the gentleman from Maine, Mr. Poliquin.
Thank you, Mr. Chairman, very much. I appreciate it, and I know this is your last hearing, and I salute you for all the great work you've done for your state, your district, and our country. Thank you, sir, very much. Mr. Hines, I salute you. I salute you for your candor on this issue. I'd like to tell you a real quick story to everybody and then ask a few questions about what happened to us up in Maine. My background is in the pension management area. So I come from the private sector. And so this is not a career for me. I was a state treasurer for a couple years. And in walking into my office, we knew it a little bit in advance. They put on our desk the fact that we had a $4.3 billion unfunded pension liability for our teachers and our state workers. For a state of Maine that has a budget of $3 billion per year, a $4.3 billion shortfall in the retirement benefits you owe our teachers and state workers is a big deal. At the time, it was a budgetary issue. We were spending about 1/7 of every dollar we collected in the state of Maine to pay for these benefits. And after working with our actuaries, it became very clear that in several years, we're going to spend 1/4 of all state revenues collected for these retirement benefits. So we made it very clear to all the stakeholders, and it took 6 months to do this, and we were very clear, reaching out to everybody you could possibly imagine beyond the legislature, but also there are citizens in the state of Maine, that these retirement benefits are at risk. And the legislature needs to make a decision. You're either going to pave the roads, buy school books for kids, put cops on the street, or you're going to spend the money to pay for the retirement benefits for our teachers and state workers. So that got everybody's attention. We fixed the problem. Maine now has one of the highest funded retirement benefits in the country. You haven't heard anything about this problem for the last 6 or 7 years because we fixed it. It was incredibly painful. But the folks who are in that program, including my dad, who's 88, now have much more security in their retirement benefits because adjustments were made, primarily for younger people coming in. So here's where I'm going with this. We have one heck of a problem here. It's Christmas. We have $22 trillion, and I am glad, Mr. Chairman, you keep putting that in front of us, just as you should. Today, the interest payments are what, Doug? $300 billion a year, roughly. Well, it's very interesting because I'm also on the Veterans Affairs Committee. Our total budget is about $200 billion a year to pay for all the health care and retirement benefits and disability issues for our veterans, and was paying $300 billion on interest payments. And as was just said a moment ago, I think, Ms. McGinnis, that we're talking about $600 or $700 billion a year, interest payments in a handful of years, exceeding what we'll be spending to defend our country. This is an issue. However, I agree with Jim completely, Ms. Dines completely, that Congress is not structured to fix a problem like this. There's too much self-interest. There are too many people here that are more concerned about getting reelected. You go out and tell the people of this country or the people in your district about this problem, about the pain they got to go through to fix it, the criticism will come over the transom. They won't get reelected. They don't touch it. So the question becomes, how in the heck do you fix this? Is it an outside event where all of a sudden foreign creditors don't buy your paper anymore? I don't know. I think it's going to be a budgetary issue. I think at some point in time, the credit card debt gets so big, and with rates continuing to go up as the economy continues to grow, it'll put upward pressure on rates, and the Fed's going to continue to raise rates. They've told us in a predictable but gradual way. You're going to be at some point in time, everybody sitting in these chairs and in the executive office are going to say, we can't afford infrastructure. We can't afford new destroyers at Bath Iron Works in the state of Maine. We can't afford national parks and to maintain them. The pain gets so tough, so acute, then you got to fix it. That's the reality as I see it from the side of the table. So my question to you, Mr. Holtz-Eakin, in the remaining time that I have, what would you like to tell us here in Congress? Where is there an opportunity? And I think, Mr. Ryder, you said the answer is no, but I'm going to ask again. The folks that are in Social Security and Medicare, in particular Social Security, which is a $17 trillion unfunded defined benefit pension plan, can you not touch these benefits that they have earned, retirement and Medicare and medical benefits? They've earned them at retirement or close to retirement. Can you design a system where that is not touched, but adjustments can be made to save this program for future generations? Can it be done?
A very brief answer from the witness.
Thank you, sir.
I'll promise you a full report. Why don't we do it that way? Because you and I have had this conversation. We do have some proposals, and I'd be happy to share them with you.
Appreciate it very much.
Time of the gentleman has expired. The chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you, sir. Dr. Bernstein, I want to ask you about business investment. So to preface this, there were some of us that actually would like to have had a tax reform measure that we could have embraced. And there were some of us who actually believed that it was fair to undertake a deep dive analysis about the competitive nature of our corporate tax rate as well. I would like rates to have gone down. They went down way more than I thought was prudent from a fiscal standpoint. And all along, we were assured that this tax cut would pay for itself. I think prima facie it hasn't, notwithstanding the assertions here today, because in part I think it wasn't terribly well designed to actually achieve that. I would have much preferred that there be more powerful incentives for business investment or non-residential fixed investment. Now, here's my understanding of the data, which is that in Q1 we actually got a bump, although not as much as was projected, and then in Q3 it collapsed again. And we're just not seeing the benefits of the tax reduction going into business investment. And part of why I'm personally so acutely sensitive to that is because I think we have a productivity issue in this country, which I cannot help but feel is somewhat related to the wage growth not having been any better than it is. So I want to ask you to comment about that. If we had designed this to be a little bit more muscular with respect to business investment, do you believe that it would have, in fact, resulted in that, increased productivity, and put more material pressure upwards on meaningful wage growth?
Those are good questions, and you've packed a lot in there.
Sorry.
No, first of all, I actually shared your, even though I'm, I think I'm a very progressive economist when it comes to tax issues like this, but I shared your interest in bringing down the statutory corporate rate, which was arguably uncompetitive. But what really, and especially in the context of this hearing, what continues to goad me about the tax plan, and particularly this area of it, was revenue neutrality should have been the lowest bar. And the idea that we would have these cuts cost trillions of dollars over a decade is antithetical to all that we're talking about today and consistent with some of the skepticism about this endeavor. In terms of investment, it's too early to tell the impact of the tax cut in the longer term, no question. But my view was that I actually didn't expect to see much of a surge in investment. I do think the expensing provisions would have had more of an effect than they did. And while I expected buybacks and dividend payouts to surge, because we've seen that before, I didn't expect them to surge as much as they have. So the shift from using retained earnings to invest rather than to pay out in dividends and buybacks, I think, is very much in the very much synced up with your question and the ineffectiveness thus far to juice up more investment spending. However, it's still the near term. The reason I didn't expect that much is because capital was already really cheap and companies were sitting on trillions of retained earnings already. Now, you can argue at the margin if you make it cheaper, you should expect more investment. We haven't seen much of that yet. But I don't think that what's driving, I agree with you that the productivity problem is surely a function of inadequate investment. The tax cut's not going to fix that. That's much more of a structural problem.
Are you saying that you don't think it is even possible, given that context at that time, large cash reserves, capital cost pretty low, to have even designed a tax proposal that would have accelerated business investment?
I think to some extent I am. I mean, I think that there is the interest rates have been very low and yet investment hasn't responded. There are, some people call it secular stagnation. There are structural factors that seem to be depressing investment. What I will say is that there are measures in the tax plan, such as 100% expensing, that you would definitely expect to lead to more business investment, and to some extent they have, but not nearly as much as was advertised or as you might have expected.
Or that could have helped fuel material wage increases. Yeah, thank you very much. Thank you, Mr. Chairman. I yield back all 4 seconds.
Gentleman yields back. Chair now recognizes the gentleman from Indiana, Mr. Hollingsworth.
Others have asked about some of these issues, but I want to get back to how we fix this, right? I can do math. You guys have all espoused the challenges of rising interest payments over time, right? Talked about how large the federal government debt outstanding today is, how challenging it's going to be to repay that over time. I stipulate to all of that, right? But history over the last 2,500 years clearly points to the fact that democracies over time go towards more and more largesse, right? So we can talk about the one-time fixes all we want to. Oh, we'll just kink this curve, or we need to raise revenue here, or we're going to cut entitlements there, or whatever the case may be, right? But how do we set up a process where we get a sustainable process for getting to a better outcome, right? Not how do we fix it one time, how do we shift this aspect, but how do we get to a process here in Congress that gets to a sustainable fiscal position over time. And that's a political process question, not just what's the mechanics of the debt question. Does that make sense? I'm a manufacturing guy. You can hire a bunch of people at the end of the line to fix broken widgets, or you can just have a process that makes good widgets from the beginning. So that's what I'm asking. How do we fix the process to get to a better outcome?
I think there are two answers to that. One is really an issue of public education so that it is in your interest to make the public happy and they care about these issues. They have no particular reason to care right now. There's been no explanation to the American people that the social safety net that they think is so important is endangered. I think that's a really big problem.
Yep.
And so you can go down that path, which builds pressure on you through the existing political process, or you can circumvent that. There is a experience globally and a research literature on the notion of fiscal rules, things imposed on, in this case, the Congress from the outside.
So let's
Balanced
talk about
budget
that.
amendment would be one of those.
Yeah, right.
And those have been proven successful because if take the Budget Control Act, that's a good faith effort by the Congress to spend less, and you can't stick to it. You can always renege.
Right.
So you have to find a way to beat that pressure.
Rules that are imposed on Congress and are unbreakable.
And they would be
such as a balanced
constitutional in our system.
Right.
That's where they would be.
I think you're right to say that public education is one route. Certainly, Germany's inclination towards fiscal sustainability is born out of their cultural experience 80, 90, 100 years ago, right? That is deeply ingrained upon them. That is an experience I don't want America to go through in order to get to that better outcome, right? So it feels like to me, rather than trying this large-scale approach of convincing the American public that their future may be in doubt because of finances far into the future and it requires sacrifice today, that is going to be a long, arduous uphill battle, but putting clear restrictions on members of Congress, on senators, and on the presidency and the executive branch to deliver a better fiscal position year in and year out, it seems to me to be the better answer. Go ahead, though.
The one caveat I'd say to that is we're experiencing the fallout of having budget problems already. The growth of entitlement spending has pushed discretionary spending out of the budget. That is everything the founders saw as the role of government. That is national defense, infrastructure, education, and you go through this, right? You say, we're going to put caps on it, and then turn out the caps are not feasible for the policies that you want. So people, there is no place in a democracy now for response to a new initiative because we've tied up all the money. That's not right.
I love that you believe that, right? But I think that the problem is it is a self-perpetuating cycle, right? Because what happens is discretionary gets crowded out, so we borrow more to fund that discretionary. No adverse impact happens today, right? I eat a chocolate bar, I don't have to go to the doctor today, but you eat enough chocolate bars over time, right? You do end up having to go to the doctor. So I feel like we're learning the wrong lessons from that because I think the public has been conditioned, right? That we can just borrow our way out of the problem. And that works, to Mr. Hines' point, until it doesn't work. And that's what I worry about with regard to this. I worry that they're learning the wrong lessons.
Can I give you one idea? From one of the things that they've seen that have worked in countries around the world is that the more transparency there is about the fiscal target and the more bought into it the public is, the better it works. It's really difficult for us because balancing the budget is really out of reach right now, and so we're looking at debt targets. It's hard to get people excited about the debt declining as a share of GDP. So here's an idea.
Yeah.
It's a bit gimmicky, but bribe us. One of the things you can do is say when you get to certain debt targets, to certain levels, then you get a tax rebate, then you get a tax cut dividend. There are ways to get the entire citizenry bought into this. And so I would start thinking about desperate measures because it's going to be from leadership or crisis.
Right.
We're hearing leadership is not jumping at the opportunity to do this.
Yeah. Well, I think that's well said, and I think that's why we need things like balanced budget amendment, perhaps incentives along the way, to ensure that leadership's incentive are aligned with the long-term interests of the country, not the myopic vision of the country. Thank you so much. I yield back my time.
Gentleman from Massachusetts, Mr. Lynch is recognized for 5 minutes.
Thank you, Mr. Chairman. First of all, I want to thank our experts. We've been blessed to have your counsel for many years in most cases. I just wish we would probably take your advice more often than we have. There is an argument for fairness in whatever route we take to try to deal with the debt. We just had the Trump tax bill passed here, added $2 trillion to the debt, and I was just going through the Center of Budget and Policy Priorities simulator to plug in some numbers, and you know, with that fairness in mind, I punched in a married couple making $50,000 will receive a tax break of about $600. And then I punched in a married couple making $1 million, they receive a tax cut of about $34,500. Now, there needs to be a certain aspect of fairness to get the taxpayer to buy in, because if we're going to do something here along the lines that you've talked about, we need to have the buy-in from our constituents. The other thing I thought was totally objectionable. We've had hearings in this committee on Wells Fargo. Wells Fargo robbed their customers. They robbed their customers. They created fake accounts without their customers. And this isn't strangers they're robbing. These are the people that actually came to the bank. They're the customers. So they robbed their customers. We gave them a fine for $1 billion. Then in this tax bill, we gave them a tax rebate of $3.8 billion. Wells Fargo was the biggest winner from this tax bill, the Trump tax bill. It's just, it's unbelievable. And I can see where people would lose faith with their government when stuff like this happens. And I know we can't solve everything at once, but there are some suggestions up here on the Hill about tackling Social Security, for instance. Now, right now, the limit on taxable income for the purposes of Social Security is like, what is it, 128.4? I think it's $128,400, and then above that, we don't tax anybody. Ms. McGinnis, you've done a lot of work on this. What would it take to sort of rebalance things and extend the life of Social Security if we agreed to raise that limit so that, okay, people making $300,000 or $1 million had to pay Social Security tax on that money as much as everybody below 128.4 has to do it right now?
Oh, if you're going to create a donut hole so it wouldn't be lifting the cap from the beginning, then it's not going to be nearly as much. If you lift the cap, and you don't pay benefits on that additional money, I think it would close about 2/3 to 3/4 of the gap. It depends. It's less over time. If you do pay benefits, much, much less. But if you exempt a bunch of people, you're still going to have to make a number of other changes. You will no matter what, and look at the benefit side or CPI or retirement age or other things.
So to maximize the benefit, you just raise the cap. You don't create a donut hole for...
It depends how you want to do it. These are your choices. But I think the really important thing is the sooner we make those changes, the more that people who depend on the program will be reassured of what they're going to get. So you need to look at the revenue side, the spending side, the retirement age side.
Yeah. Well, I see these young people coming out of college with, you know, they're up to their necks in debt. And so we have to find a way to actually provide for them to have some Social Security at the end of their working lives. I think it's a basic, you know,
And I would add that there are also going to be other needs as the social contract has to be updated as the economy changes. One thing that's clear is we're going to be needing to learn through our entire careers. It's not going to stop at 18 or 22 or 25. So there are also a lot of other needs that are being pushed out as we're focusing on that one piece of the social contract. A lot of investments we have to think about as well.
Right. And I've seen that even at the state level where we have restricted federal funding for infrastructure, roads, bridges, things like that. But then I go to my town meeting and I see that the local communities in the state and cities are increasing their taxes because they've got to pick up more of the load. I think 10 years ago, the contributions at the state level for infrastructure and transportation were about 67%. 10 years later, it's almost 72%. So by our unwillingness here at the federal level to raise taxes and provide revenues for infrastructure, we're just pushing that responsibility onto the states. And so the taxpayer is paying at the end of the day anyway.
mean, it's interesting because in many ways it is all like a balloon, where if we're pushing it on one part, it's affecting us in another part. And the bottom line, because we're all taxpayers, whether it's the federal level or the state level, the local level, we have to come to terms with what we want to spend, how much we want to spend, and how we're going to raise the revenues to cover those costs. And we're always kind of looking for the free lunch way out of it. We're not going to find it.
Right. Well, again, thank you for your testimony, and I yield back the balance of my time.
Thank you. The gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
Thank the chairman for yielding, and again, I thank you all for being here. It was great dialogue, even from across the aisle, to hear about the structure of decision-making, the urgency, and the candor on this issue. So speaking of urgency, I always tell folks that our growing national debt it's one of the most pressing problems of our time. It's a threat on multiple fronts. It threatens national security. It threatens important programs like Medicare and Medicaid that we've talked about today. And it threatens to drown out necessary spending on other important federal initiatives. So even though most of my constituents are not working full-time at think tanks, they're able to look at the amount of money that we take in each year and the amount of money that we spend. And when they say that Congress hasn't done its job to get control of our spending, then they're exactly right. One of my biggest concerns is looking at how much we're spending on our debt interest each year. The fact that we're spending more on interest than we are on things like education, infrastructure, other important medical research, that should be a clear sign to all of us that we've got a problem. Ms. McGinnis, I'd like to start with you with a question. And let me just first say I really enjoyed our time earlier in my term when you came into the office. We were able to first start talking about this issue. So thanks for all you do, not only with our office, but with so many others and keeping this front and center. Ultimately, our future is our children, and we're leaving them with a massive debt. Can you comment on how much we spend on interest versus how much we're spending on issues related to supporting our children and their future?
Right, great point. So as we're spending $300 billion roughly on interest now, it's going to triple over a decade. As of next year, that is going to be more than we spend on children at the federal level. And I do think that the budget being about priorities, it's just such a clear mistake that we are focusing on financing the past instead of looking at investments in the future. And this is more than anything an intergenerational issue, and I think that reflects on it, reflects sort of the choices we're making perfectly.
Thank you. Mr. Riedel, again, thank you for joining us. And I'd like to switch over and ask you, you have written it that if current policies continue, the national debt is projected to reach an unprecedented 194% of GDP within 30 years. What's the source of your projection, and in your view, are either inadequate tax revenues or defense or other discretionary spending the root cause of this?
194% is just taking the CBO current law baseline that says 152% and adjusting into a current policy baseline that assumes the tax cuts are extended, the new discretionary spending levels are extended. The danger is that 194% assuming interest rates never rise above 4.4%. If interest rates go up to 5, 6, 7, 8%, you could easily have a debt ratio of 250 to 290% of GDP. And I think most economists would agree that if the debt's getting that big, of course you're going to have some interest rate effect. In terms of what's causing it, revenues are historically 17.4% of GDP. They're going to about 19 or 20, depending on the fate of the tax cuts over the next 30 years. Spending is historically 20, it's going to 30. So just from mathematically speaking, for getting what policies you want, you're going to have the highest sustained tax revenue level in American history, but it can't keep up with spending going up 10% of GDP.
So follow-up question. According to CBO baseline, the total deficit for the period 2019 through 2028 is expected, as we've talked about this morning, $12.418 trillion. In your professional opinion, is it reasonable to think that the U.S. could cover this estimated $12.418 trillion deficit entirely by cutting discretionary spending? And if not, why not?
It is probably mathematically impossible.
Mr. Budd, can I make a very quick point that I think you'll actually appreciate?
Briefly, I'm very short on time.
Very short.
I might reclaim my time.
One way to make interest rates go up higher than they would otherwise would be to threaten default when the debt ceiling debate comes up next year. And I strongly advise members of this committee to avoid getting into that really destructive own goal kick kind of fight.
So noted, thank you. And I want to continue on. So, and could tax increases alone solve this deficit problem?
If you took, I mean, if you doubled the top two brackets of 70 and 74%, you would get about 1.5% of GDP against a current policy baseline deficit of 7%. So no.
So how about if we included the middle-class families? Could we do this? Could we solve this problem without increasing the tax burden for middle-class families?
Over 30 years, if you just wanted to stabilize the debt at 95% of GDP, just stabilize that, you'd need a 45% payroll tax rate or about a 60% VAT.
Undoable. So may we tend to this issue, and may we have many Merry Christmases to come. Thank you.
Time of the gentleman has expired. I want to thank the witnesses for their testimony today. Prior to adjourning the hearing, I want to recognize that depending upon the timing of a CR vote, it is not my last hearing, but it may be others' last hearing, depending upon the timing of such a vote. And although I cannot literally hand over a gavel to my successor, since all I's have not been dotted and T's been crossed, I do want to at least rhetorically hand over the gavel. First, I would like to say it has been a great honor and a privilege to be able to lead this committee for 3 terms. And in this committee, we have had partisan differences. There is a reason there are 2 major political parties. But I also take great pride in the fact that we have been able to achieve many great bipartisan pieces of legislation. And indeed, versus every other committee in Congress, I take pride that we have passed more bills and had more bills signed into law than any other standing committee in Congress. And although there have been a few exceptions, I think by and large that we have conducted the debate in this committee with decorum and with respect, and it has been debates that are worthy of the American people. And so with the election, there will be a change in power in Congress, including this committee. And as I've said before, as a very conservative Republican, I'm getting ready to hand the gavel to a very liberal Democrat. So there is very little that I have agreed with the ranking member on. But here, and I've disagreed with just about everything she has said and done, but here's what I know. In the 16 years I've been on this committee, the gentlelady from California has been a leader. And she has commanded respect, and she has commanded people's attention. And as I've been the chairman for 3 terms, she has always negotiated in good faith. She has been thoughtful on the issues, and most importantly to me, her word has always been good. And so somebody may misconstrue the words that I'm about to utter now. I don't believe she will. The ranking member and I are of different ages. And she has come to accede to great political responsibility and power in an age in our country when it was very difficult for women and very difficult for people of color to do that. And that is a testament to her tenacity. It is a testament to her drive. And that alone means she commands the respect of every member of this committee. So again, as a conservative Republican, I'm finding it a little difficult to wish you success, but I wish you health. I wish you happiness. And I know that under your leadership, I feel confident that the Financial Services Committee will continue to engage in debates that are worthy of the American people and continue to produce bipartisan legislation that ultimately will inure to their benefit. So, ranking member, I will not be here when you physically take the gavel, but I at least wanted to rhetorically, in this fashion, hand it to you and wish you well.
Thank you very much, Chairman Hensarling.
Well, I didn't exactly recognize you, but now ranking members recognize.
Thank you very much. I am a bit overwhelmed with your generosity in describing your relationship to me and the work that we've been able to do together, and the fact that we're on different sides of the aisle with different perspectives, how you have indicated your respect for me and what I have been able to do even when we disagree. I want you to know that I have, of course, worked closely with you. I've observed you even when you didn't know I was really observing you. And you have managed this committee with great dignity. And you have managed it in a very fair fashion. And I am going to emulate much of what I have seen you do because you have done it so well. The only thing that perhaps I have to learn a little bit better is when you start to warn the speakers that they are coming near their 5 minutes, and you do it so well. And I'm going to try and learn how to do that. But let me just say that as we have sat here next to each other, and we have had moments that we were in close conversations, and we were enjoying a laughter between us. I know there were many out there wondering what could they possibly be laughing about, and not understanding that perhaps it was only a few moments prior to the laughter when we were saying some things about each other that didn't sound so generous or so nice. But you and I know, and you and I understand and understood exactly what we were doing, and there were times when we certainly were able to agree on bipartisan efforts, and we were successful with many of them. And so I'm pleased that I've had the opportunity to work with you. And again, you have always kept your word, and you have stuck to and fought for your principles. And so where we identified issues where we could partner to reach bipartisan solutions, we have worked together in a productive and effective way, which has sometimes surprised again and confused the press. So ultimately, Chairman Hensarling has been very dedicated to his work, chairing this committee, and I am so appreciative that I've had the opportunity to work with you, and I thank you for your graciousness in passing the gavel, even though it's a little bit rhetorical. I want you to know that we had our final vote today in caucus. And so it has been done, and it's all right for you at some point to really hand it to me. All right. Thank you, thank you.
I thank the gentlelady for her kind words, and I appreciate the indulgence of our witnesses. Without objection, all members will have 5 days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. This hearing now stands adjourned.
Thank you so much.
Well done, sir. My shout out to you was that we can't handle the tax cut that's worked very hard.
Exactly what I'm supposed to be doing this tomorrow. That's a big thing on that. Too early at the point.
Well, right.
Exactly, yeah.
Well, saying it's Groundhog Day all over again. we keep thinking one day somebody will actually.
That was the way you made my week.
Well, you know, it's not all what you think it is.
No, that was.
I feel like you made my holiday by getting to see that. Thank you for doing this hearing.
Well,
Thanks for having
Yes,
me.
thank you very much for bringing attention.
I don't know about anybody else, but my I will sleep soundly tonight and my conscience will be more clear.
You're doing your part.
Thank y'all. Keep
Thank you so much.